Perhaps we can kick off the panel with each of you sharing a brief update on your businesses and how they've been impacted by COVID-19. It's an open-ended question, but maybe each of you could give us a quick rundown of what you and your teams have been up to over the past few months from an operations, cost and safety perspective. Maybe keep them to 2 or 3 minute responses each, and John, I'll start with you.
Okay, thanks. Thanks very much. And thanks, Aaron and TD, for having us on today. Certainly, first and foremost, I'm happy to say that all of our Tervitians remain safe and healthy, and none of our operations have been directly impacted by COVID-19, largely due to the quick response of us enacting our business continuity plan and forming an internal COVID team. We are an essential service, and we are happy to see that all operations are continuing on from that perspective. From a business perspective, operations perspective, as you know, Q2 has been a challenging one for the business and energy sector. Producer shut-ins and material drop in energy prices had an impact on that business, with WTI dropping below zero during the quarter and Canadian differentials collapsing, impacting our energy marketing ability to track volumes. Many of our customers did have shut-in volumes, especially in the heavy oil region, where it is less economical to continue production. We are hearing optimism from the field, with volumes being brought back online in late June and into July, as WTI and Canadian prices has improved. Amid the downturn in production, I'm proud to say that we did commission our water facility in the Montney, which contributed to an uptick in third-party water injection volumes. We are working with customers and applied to the Orphan Well program across BC, Alberta, and Saskatchewan, and expect that to benefit an environmental service line, the landfills, but later on in the year and into next year. We did receive funding from the Canadian Wage Subsidy, 3 payments, and lastly, very importantly, we were very quick in responding to COVID-19 and took numerous steps to proactively reduce fixed costs, maintain margins, protect liquidity, with the majority of the actions taken late in the first quarter and early in the second quarter. And we are on track to expect annualized savings of up to $34 million.
Ray?
Yeah, good morning, everybody. Hope everybody's safe and healthy out there. Similar to Tervita, we enacted our emergency response around COVID-19 and had zero impact to our employees and operations. And a big thank you to our team out there that put into action so early when it was initiated by our employees that their health and safety was paramount to everything we do. And knock on wood, it hasn't been an issue through the entire time period since it started. Similar to as John spoke, we've seen production come back on in late June and more nominated in July and August when it comes to light sweetened condensate. Definitely those the higher netback wells are coming on pretty strong. We saw strong demand in our storage business in Q2, and that'll spill over into Q3 and Q4 at Kerrobert and Cushing. It was a wet quarter, so obviously even those that wanted to drill and complete wells, it just wasn't going to happen in Q2, and we should see some of that demand uptick in Q3 here as it just dries out up north. But it's been an extremely wet quarter all in all. And our environmental projects, similar, need dry conditions to get out there, get the equipment. And so second half bookings are quite strong. And similar to the government programs, which I'm sure we'll talk about more later, will, I think, be huge incentives for activity to kick off here in the second half, never mind 21 and 2022. From From a cost point of view, absolutely, it was imperative that we acted early and quick, and our G&A and op costs have definitely been trimmed quite a bit, and on an annualized basis, it's around $40 million that you'll see kick in second half and into next year. And then we have the one major project that we've been building since last November, which is the Kaybob oil gathering system, and that started up July 1st. On budget, on schedule, so real happy how that thing has been executed. And then finally, from a ESG point of view, we just updated our scoring system, and we've improved our scores in all major categories with ESG, so we're real proud of that. But that's the quick, the 3-minute update, Aaron.
Sure. So your businesses are similar in a lot of ways, but for the benefit of investors on the line, and maybe to not get duplicate answers, can you maybe give us a bit of an update on the businesses lines where you differ? And Rennie, I'll start with you. You touched on it, but perhaps you could give us an update on the pipeline and terminaling business, what's under construction, what's already working, and how the operating assets have fared so far through the last couple months.
Yeah, I mean, back in 2016, we made a conscious effort that the incremental capital, growth capital that we were going to put to work was going to be around more midstream type related assets, and that only not only meant oil but also water pipelines, and certainly we wanted to get them backstopped with customer contracts, and some of those contracts are as long as 15 years. And so when you think about our assets that we've put to work, the Kerrobert pipeline system, which is well over 60 kilometers from the Viking play up to Kerrobert that goes into the Enbridge system, was a pretty big project. Our first oil feeder system that not only requires operating storage, but we also wanted to put in merchant storage for our customers, and so that's been now running since October 18, and we haven't had 1 hour of downtime. It's been operating safely, and the customers have continued to add more and more production barrels onto that system. So it's been a great success story. And then, as we just mentioned, Kaybob is really pulling in three different producers to justify that system, and essentially is taking trucks off the road. And obviously, from an environmental safety point of view, that's a good thing. And that, like I said, got kicked off here July 1st. And so those are our two main oil gathering, and I guess the third would be our storage down in Cushing. We have 750,000 barrels of storage down there, and again, helps our customers get better netbacks for their oil as we get out of Canada. And it certainly was a kind of a crawl before you walk type play, and we wanted to understand that market, build it up, and we do have optionality there to build more storage. And as we are able to secure customer contracts, that'll probably drive that expansion. So overall, I think we'll continue, whether it's oil pipelines or water pipelines, so that we're taking trucks off the road. We don't own any trucks, but we just think from an environment safety point of view, it makes sense to continue to build that type of infrastructure and certainly help our customers reduce costs.
John, do you want to give us a quick update on the industrial segment? Obviously, there's a couple different businesses within that segment, not all energy weighted. So maybe you could give us the rundown there.
Yeah, thanks, Aaron. We continue to see the benefit the industrial services segment provides to our business model from a diversification perspective. And that business segment, or industrial services, is made up of really 4 key service lines. Metals recycling and rail services. So inside of that metals recycling, we have 4 locations across Western Canada. We have water services as a separate line. Waste services, so that's your typical bins and roll-off trucks and that sort of thing. And environmental services, which is consulting and remediation work, which largely fills into our landfill. So, while the division was slightly impacted by the contraction in the economy following, COVID-19, it is largely insulated from fluctuations within oil and gas. There really isn't a metric to benchmark industrial against, but we generally say that it tracks with GDP and the overall economy. And it's pretty resilient through these trying times. It really didn't reduce much in Q2, and we see good upside we have in the last 3 years, and we continue to improve that. And it serves a wide range of customers. For instance, in the rail business and mining, construction, agriculture and manufacturing sectors, and of course energy customers. And once the economy has returned to normal, we intend to continue with growing this business. We are very excited about the prospects for the business, both from an internal growth capital project perspective and M&A and selective acquisitions. And we see it really adding up to a pretty good business development opportunities for the company as we go forward.
Okay, great. John, I'm going to stick with you first. But each of you have some upcoming debt maturities. To the extent that you can share, can you walk us through some of the specifics and some of the recent progress that you've made on that front? And John, specifically, you've got the 2 tranches of notes due in December 2021. Obviously, the maturity is still a ways away, but it's still a fairly large amount collectively at US $590 million outstanding. Generally speaking, do you think the recent stability in crude oil pricing has created an opening to refinance, or would it still be challenging to get something across the line?
Yeah, thanks, Aaron. Well, as you know, we do have time. It's up to December 2021, or about a year and a half or less. We're actively looking at various avenues to refinance our debt. Our banks and current bondholders are extremely supportive of Tervita, and we continue to engage with them both as we look at the various refinancing options that are available to us. The company is in a strong position, given that we're production-weighted profile and industrial diversification. And, I'd have to say that we're confident in our ability to get our refinancing completed well before our notes mature. And recently, certainly not in the beginning of March there, but we are starting to see signs of the high-yield debt market reopening, and we are certainly ready for that when the window opens back up. It's really a question of the cost on the financing and the clip that we can get at. So, we're pretty confident of where we're at, and we see we'll be able to do that much before the notes are due.
And Rennie, Secure's obviously got a smaller second lien facility that matures at the end of July 2021. Are you in the process of extending that facility, and how are you finding the reception with your syndicate?
Yeah, I mean, in that case, it was a secured second lien term note of 130 million Canadian, and we definitely have had conversations with. It's really 3 banks involved, 2 majors and a smaller bank, and we've had conversations to either just extend the term or roll it into the revolver. And as we evaluate the different cost options in terms of interest rates, we'll probably, be able to put that to bed in the next 3 to 4 months. So it's certainly I think our average weighted interest costs right now are around 4% with our revolver and that term loan. So we're pretty confident in our ability to take care of that over the next 90 to 120 days.
Switching gears a bit, the core assets in both of your businesses, I mean, you guys have the luxury of having produced water and waste streams continuing to come in, which adds a bit of stability in the near term. But a major factor in facility profitability and margins is the incremental volumes that come from drilling and completions weighted activities that may not come back for quite some time. And so in a low production growth scenario or a low capital spending scenario, could you give us a sense of if you think the market is currently adequately supplied, undersupplied, or oversupplied? And how will that shape your capital allocation strategy in a recovery scenario? In other words, do you think you'll be spending on organic capital, M&A, focusing it towards net debt reduction, paying a dividend, repurchasing shares? And Rennie, I'll start with you.
Yeah, and it's a great question because certainly, there's what no one's talking about right now is obviously slowing drilling and completion activity is probably going to be there short term, because if I'm a producer, I want to live within free cash flow, and maybe any available excess cash flow goes to paying down debt. So, but what no one's talking about is the high decline rates with a lot of the wells that were drilled the last 5 years, and so that's something that as a producer you can't push off drilling completions forever, and certainly there's a short-term production scenario where the production will come off, whether it's light oil, condensate, or gas. And so I think you'll see that play out over the next 6 months. And the other thing that we found over the last since really 2012 was that there's always pockets of markets where you're oversupplied or undersupplied. It's never a straight line, and certainly our customers are smart enough to know that they'll put the money and build up their production profile and bring on new production where they get the best net back. So that's going to kind of play out over the next 2 years. So I wouldn't say there's zero organic capital or expansion capital. It's probably going to be very targeted. And then from there, we do, even in a tough year like this, we do have a lot of free cash flow that we can put against the debt. I think that'd be number one. And then certainly, depending on our share price and or increasing our dividend, those will be things that we kind of contemplate from quarter to quarter.
John, I'm realizing that we've got about 2 minutes left. So maybe you could touch on anything unique or different that you might add in that question, and then touch on how impactful the $1.7 billion in federal government funding earmarked for the orphan well cleanup might be to you and your business.
Yeah, I just on the market issue, the oversupply, I agree with what Rennie is talking about there. I'd say generally some areas are obviously busier than others. We'll evaluate all capital opportunities, organic growth, consolidation, and reducing debt against internal hurdle rates, and we'll prioritize that accordingly, and have done so since the beginning. The federal government, the $1.7 billion, there's really BC, Alberta, and Saskatchewan, and both, Secure and Tervita benefits from that. Our rough guess of the $1.7 billion available to our businesses would be about half of that. The government's a little bit slow in providing their applications, and nobody's really seeing it, although Tervita is a prime contractor for the Orphan Well Association and the BC Oil and Gas Commission. But we do see that benefiting us from an EBITDA perspective in the last half of this year, more in Q4, but principally next year and the year after, and mostly in the landfill side from a larger perspective.
All right, and I think we've got about 30 seconds left, Rennie, if you want to add something there, and if not, we'll leave it there.
Yeah, 100% agree with what John's saying, and the first part of this is more what they call phase 1, phase 2 consulting, but the big money that needs to be spent here is really our environmental solutions and the actual getting the contaminated soils to our landfills. So absolutely, it's a big number, and there's going to be a lot of that needs to be spent by the end of 2022. So it's going to really come over the next 2.5 years.
Great. Well, that's our time. Thank you both very much for